been an interesting month and an interesting end to the quarter. Let's take a quick hit at the September headlines. The Fed taper timeline.
Yeah, the Fed September meeting wrapped up, and the big news was that apparently the taper is going to start potentially in November, so sooner than was previously expected by the market, and it's going to wrap up mid 2022, so it's going to wrap up quicker than the market previously expected. And now the question is, are they actually going to be able to get through the taper? Is Jerome Powell going to be able to see the taper through, given that he's up for renomination next spring? And if they're going to get it done, they should go quick, because the economic data is starting to pick up, and they sort of have a short window. So there's a chance they could actually get through it.
So the equity market update, reflation 2.0. Are we here?
So you look at the COVID data, you look at how the economic data is coming in relative to expectations, you look at the types of stocks that are doing well, particularly late in September, and it looks very similar, like a setup for a reopening trade 2.0, something like we saw last fall. As we head into the holiday season, more spending on services, more spending on Christmas items, more travel. There's potential here for more economically sensitive, smaller, more value-oriented stocks to do really well through the end of the year.
And along with that, COVID cases are rolling over and on the decline, so good support for reflation 2.0 and a good holiday season. How about China Evergrande?
Yeah, is it China's Lehman moment? And our view is no, this is nothing like Lehman Brothers. This is a very different situation. There's going to be a tremendous amount of support from the Chinese government to make sure that, yes, some folks experience losses here, but there is not widespread social unrest, and there are no problems with the banking system, which is pretty much nationalized anyway. So no, for a number of reasons, we do not think this is anything like Lehman. Also, if you go back just 12, 18 months ago, we were dealing with an unprecedented economic crisis, and there were no concerns about how the global financial system would handle this. So it's tough to say that the global financial system is going to have a problem handling a default of China Evergrande.
All right, the debt ceiling. Is it just political theater, or is this something we should really be worried about?
Nobody knows what actually happens if the U.S. defaults. There are a number of options to explore, but our view is that the U.S. probably will not default. Very interesting intellectual exercise to go through what would happen if they did. So that's probably the most interesting thing about this whole situation. But our view is no, the debt ceiling will be raised or suspended, most likely, probably at the last hour.
All right, and the last headline is the just confusing labor market. We would expect that to not be where it is today. What goes on here?
Yeah, still record level of job openings that are not getting filled. Labor shortages are rolling through the economy and creating disruption in a lot of different industries and businesses. And if you look at how the Fed has changed their tone, shortening the taper, getting that done more quickly and aggressively, potentially raising interest rates quicker than they previously signaled, they might be concerned about inflation running hot for an extended period because of how tight the labor market is, because of something like a wage price spiral, which is something we haven't seen in this country since the 70s and 80s. So very interesting to look at that data and see if there actually is potential for that.
Let's take a look at the bongo board here and preview what had happened.
Yeah. So we'll focus all the way to the left, the month-to-date chart. Once again, these are the returns of various asset classes that are typically included in a diversified portfolio. So for the month of September, S&P down 4.65%. That was the worst month for the S&P 500 since March 2020. You also see red numbers in all of the equity asset classes we show here, as well as the bond asset classes. And this is the first time we've seen negative monthly returns for equities and bonds at the same time since September 2020, interestingly enough. But if you move a little over to the right, you can see quarter to date, the S&P 500, another positive quarter. That is the 6th consecutive positive quarter for the S&P 500. And we can start to dig into some of the volatility, because really the last 2 weeks of the month made the month, and the month made the quarter, is how it really played out. And the volatility really started to pick up as we got to the Fed meeting on September 22nd, where the Fed adjusted the taper timeline. They adjusted expectations for when the taper would start. And what you saw was a lot of volatility for the equity market and in the fixed income market. Interest rates jumped. So interest rates in early August, the 10-year Treasury yield was 1.18%. It jumped to 1.5% after the Fed meeting. And so that's how you got negative returns in the bond market. And then as that was happening and interest rates were rising, those last couple of weeks of September, large growth stocks really started to sell off. And those dominate the S&P 500. So large growth stocks were down almost 6% during the month. Value stocks held up much better. Smaller cap stocks held up much better during the month. Some other comments to make here for foreign equity. Still no dip buyers in China. The MSCI China index down another 5% during the month of September. Sort of flatline there in August, but July and September were both very bad months for Chinese equity market returns. That's why you see that big negative 8% quarter to date return for the MSCI emerging markets index there. And then the positive note on the board for September was commodities. So up another 5% during September. Now by far the best returning asset class year to date, up almost 29%. It's been every commodity subsector has had its turn in terms of generating positive returns during the year. For September, it was primarily the energy sector, not just oil, but natural gas, up almost 30% during the month.
Let's start with the taper timeline and talk through what the Fed sort of has on tap right now.
Yeah, the Fed's meeting wrapped up September 22nd, and the big news was a change in language from Jerome Powell with regards to the pace and the starting point of the taper. The overall conclusion here is that it seems like the taper is going to be starting very soon, perhaps at the next meeting, so in November, and that the taper should wrap up mid next year. So this is quite different from what the Fed said at the prior quarterly meeting in June.
Yeah, it's the market reaction to this seems to be, I mean, we expected last time this happened, there was a taper tantrum. What's the take on the market reaction to this, and what do we expect? Have we just not seen it yet?
Yeah, so when the Fed came out in June, their communication with regards to the taper and interest rates were generally more hawkish than what they said in March. But the market reacted in a way where, if you look at interest rates, the yield curve flattened. So the idea was, yes, the Fed they're messing up. They're going to go too quick. They're going to shorten the economic cycle. And in terms of the types of stocks that did well in the equity market, it was growth stocks. It was sort of stay at home forever type stocks. So very interesting. And then when you go from June to September, the messaging was once again more hawkish. So September is the most hawkish messaging around the taper and interest rates. But you had the exact opposite market reaction. So you actually saw in September the yield curve steepen quite dramatically. So the 10-year Treasury yield went from something around 1.3% to 1.5% very quickly. And then the type of leadership within the equity market, you saw more cyclicals, more interest rate sensitive sectors, things like financials do very well. So the same sort of surprise, both hawkish surprises, but the market outcome, the exact opposite. Which is very interesting.
Yeah, it is pretty interesting. Let's look at the next chart here, if we can pull that up, at the actual path of tapering and what the balance sheet would look like based on what we know today.
Yeah, we take a look at the Fed's assets, somewhere around 8.5 trillion right now. And then we get into the two colorful lines. So the green line is what the consensus was, what Fed assets would look like based on the consensus around the taper timeline. So that's the green. The prior projection after the June meeting was something around 15 billion in tapering per meeting. So at every meeting, there are 8 meetings in a calendar year, they would reduce the pace of asset purchases from 120 billion currently, they would reduce it by 15 billion until they got down to purchasing no new treasuries or mortgage-backed securities by the end of next year. So it was 15 billion per meeting starting in January 2022, wrap it up at the end of 2022, and we're all done. So nice and clean in the full calendar year next year. And then you'd see the Fed's balance sheet, if they were to have followed that timeline, would have topped out at something around $9.7 trillion. So in taking the punch bowl away, they're basically adding $1.2 trillion to the balance sheet. So not that hawkish. And then you see the red line, which is the updated projection after the September meeting. So much quicker. So 15 billion in tapering per month as opposed to per meeting, and then starting sooner. So starting this year, perhaps at the next meeting in November, and wrapping up mid 2022. So there you see the Fed's balance sheet tops off at 9 trillion. So 500 billion more than we're at today. So net, you're talking about the Fed getting down to 0 monthly purchases 6 months sooner than we previously thought. They're going to start tapering about a month sooner than the market previously thought, 2 months sooner. And then their balance sheet should be $700 billion smaller than investors were thinking previously. So a pretty significant change in guidance only in 3 months. And what's the Fed watching? Well, their dual mandate apparently is employment and price stability, right? And the employment data hasn't been great from June to September.
Right.
But you would look at this change in projection and you would think the employment data was picking up rapidly. So they're clearly not reacting to that part of the mandate. It's more the inflation side seems to be spooking the Fed.
So the tapering is one element. That the sort of the big jump in our minds was what happened to interest rate expectations, because following the tapering, there was talk about when will rates move higher.
What the Fed and Powell have said is that interest rate hikes should not be at all dictated by the timeline of the taper. However, now that they've adjusted the timeline of the taper, it seems like the first interest rate hike is going to happen sooner. So clearly, the Fed does think they need to get through the taper and then hike interest rates shortly thereafter. So clearly, the taper does dictate interest rate hikes. And what does the market think of all of this? That's what we see on this chart. So the green line is what the market thinks short-term interest rates are going to be over the next 1 year, 2 year, 3 year, 5 year, 7 year, 10 years out. And these numbers are struck as of July 19th. And this was sort of the depths of Delta variant, where the consensus was, economic growth is going to really disappoint and we're going to be stuck with COVID-19 forever. And this was basically the low point for the year. So the market was thinking 5 years out, maybe the Fed will get the federal funds rate up to 1.125, 1.13 if you round it percent at the end of the next 5 years. Not even up to the 2% inflation target they have. So basically, interest rates are going to be low forever. And then very quickly, from July to September, if you look at that 5-year number, it jumps 0.5%. So now pricing in a couple things. And this is also why we think the market reaction this time was so much different than when the Fed changed their messaging from March to June. Because the economic data is actually starting to improve. The COVID data is starting to improve. Economic data is starting to come in a little better than expected, or at least in line with expectations. That happening at a time when the Fed is signaling more hawkishness, that is why you got a big increase in the expectations out to the 5 years. So now 1.63%. And if you move all the way over to the 1 year, so that's in the next 12 months, you can see there's your first rate hike, 0.23%. There's your first rate hike end of next year.
Let's move on to the equity market update, sort of our reflation 2.0. I mean, clearly the good news in this update is COVID cases are on the decline, especially in the last 2 or 3 weeks. They have significantly decreased. So have hospitalizations and deaths seem to be peaking as well. So that seems to be driving a lot of the good news in a lot of these items, especially in the reopening. So let's talk about COVID and its impact on the reopening.
Yeah, this has definitely been a welcome sign. So after cases peaked right around in August, sort of peak of Delta, they are coming down. And in our view, it doesn't matter really what you attribute them to. We've talked about how vaccine mandate, we talked in earlier videos, vaccine mandates are coming and that should reduce case counts. We talked about the percentage of the population over 65 vaccinated. We've talked about the newfound strength of natural immunity. It doesn't really matter. We said if this is all going to work out, it's going to show up in the data, and it's showing up in the data.
Exactly.
And this is right in time for the holiday season, and at a time when the sort of reopening winners in the equity market. You think, leisure, hospitality, airlines, the types of styles that did well in a reopening trade, like small value, for example. They basically gave up half of their outperformance from earlier in the year over the past few months. So
Yeah.
all those same reopening trades are more attractively valued now than they were in April. Um, and the case counts are starting to roll over. We're seeing it in the data, and it's all great news. And it sets up something like a reopening trade 2.0 as we go into the holidays, which would be great.
Yeah. The last 2 weeks of September, the bookings, airline bookings, started to turn the corner. They definitely bottomed out there, and we've seen a swift turnaround. So hopefully, you're saying we won't have to cancel Christmas.
We'll see. Too soon. Apparently, it's too soon to
Too
say.
soon too soon to tell.
Yeah.
All right. So let's look at some of that high frequency economic data.
Yeah, to your point, this is what we've been watching because whether or not there's more lockdown stringency, consumers are smart. They're going to voluntarily socially distance if they fear the Delta variant and case counts are rising nationally. And so we watch open table seated diners in the dark blue, TSA checkpoint traveler throughput in the light blue. You can see how they both sort of rolled over there in July and August and now have stabilized. And our expectation is now, these data points are very sensitive to COVID case counts and the news coverage. And as COVID case counts continue to fall, hopefully, these numbers should go back up. They also typically increase around the holiday season, or they should, absent COVID. So if we get a better virus environment heading into the holidays, um, these numbers are going to go up. This is the economic surprise index. So when this number is above 0, that means economic data, whether it's strong or weak, it's coming in better or worse than expected is the key. So when it's above 0, it's coming in better than expected. When it's below 0, it's coming in worse than expected. So how you interpret this chart, June 2020, the economic data was awful, but it was not as bad as expected. And that's why the index was so firmly positive, right? And all throughout 2021, the economic data has been great. But as we got into July and August, you started to see the impact of Delta, where the economic data was good, but coming in worse than expected. And now you can clearly see that starting to turn. And so once again, it's all showing up in the data. It's all setting up for something similar to what we saw a year ago, where you had the big reopening trade. This time the catalyst might be the idea that, hey, hopefully this is the last wave of the virus. Last year, the catalyst was, oh my God, we have a vaccine. So it's all showing up in the data. It's all a similar setup.
And let's shift over to the next chart and talk about the effect on the value and the growth impact, because that is a great chart to look at what was happening up until March of this year. And then now we think it's starting to make its way back.
Yep. Yeah. The red line is the steepness of the yield curve. So the difference between the 30-year yield and the 3-month yield in terms of the U.S. Treasury yield curve. And so we start this chart in September 2020, and you see the yield curve steepening all the way through March. And the yield curve steepens because economic growth expectations are getting better. Inflation expectations are rising. Generally good news for the economy. As that yield curve is steepening, the other thing we're seeing is the blue line, which are small value stocks outperforming large growth stocks by a huge margin. From September 1st, 2020 through the end of March 2021, small value outperformed large growth by almost 60%, 60. And, very different styles of companies. Large growth companies, think of the mega cap, MAGA F type names. They're supposed to be able to grow earnings in any economic environment versus small value stocks, more financials, banks, materials, industrials, REITs, things that are more economically sensitive and do very well when the economy is rebounding. And so that was the first leg of the trade. That was sort of reopening 1.0, if you will. And then there was a consolidation period from March through about mid-May, and then we got into Delta. So from June through August, small value stocks really underperformed. The yield curve flattened quite a bit, and then you see this big jump here in September. And that jump in yield curve steepness and in the types of stocks that were doing well during the month, that jump happened in the last week and a half of the month, and it totally made the entire month, and it even made the entire quarter.
Yeah.
So that's really where the volatility within the market came from. It was those last few weeks as the Delta data was getting better, economic data was starting to come in better than expected, and then the catalyst was the Fed saying, hey, we're going to be a bit more aggressive in the taper and potentially interest rates.
Let's move on to a very big news topic out of China, the Evergrande group and its potential default here. And there's a lot of noise around this, what this really means to the market. It's generally, in our opinion, I think misunderstood as what the magnitude of this is. And you don't really get a lot of inside details. You just see the headline. So our research team has pulled some data here, which they did a great job on, and let's share it with the group.
One thing before we start into this is you have to come to the realization that no matter how much research or time you put in, you're never going to know all the exact facts, okay? Because they're not going to get out.
Yeah.
So what's more important is thinking about how do you think about this situation, and what we've seen is people are thinking about it the wrong way in our view, is that they're tagging this the Lehman moment. So this is China's Lehman moment. And obviously that's referring to Lehman Brothers when they were allowed to fail during the 2008 global financial crisis. That was viewed as sort of the straw that broke the camel's back and created the global financial crisis that eventually happened. This is so different in so many ways. The first thing in this chart that you can see is China Evergrande as a percentage of that country's GDP is far smaller. So that's one thing. Second thing is Lehman Brothers was a very large global financial institution. The contagion risk was everywhere. They were intertwined with businesses and other banks all over the world. So when you look at this situation, we like to take what's called the money view. And we didn't come up with that, so that's from the teachings of Perry Merling. But basically, the money view suggests two things. The first is if someone defaults, everybody's debt payment, for example, is somebody else's income. So that's a problem. That's where it starts to hit the fan. That can be handled because if that's just somebody missed a payment, well, a government, for example, the People's Bank of China, can make up for that and make you whole. Incomes can be whole. That is what is happening here with China Evergrande, sort of the first level. The second level, which is a far larger problem, is when there's a financial instrument that is used and considered as good as cash, and then all of a sudden it is not. That is a huge problem. That's what happened in 2008. AAA rated mortgage-backed securities were used as collateral for almost all financial transactions globally, and then all of a sudden everybody thought these things were good, and it turns out they're not, and all those financial transactions have to be unwound. That is not happening with China Evergrande. There's no confusing China Evergrande debt is not being used as collateral in repo transactions.
You can't stress enough how important that point is alone, and how the difference between these two entities are.
Exactly. Yeah. I mean, we're hoping that there aren't global money market funds that are buying China Evergrande paper, short-term paper, and therefore you're creating a liquidity crunch in money markets. It's very different. It's very different.
Yeah.
So that would be the first thing. And then, the next thing is who really is going to lose money here, because China has to manage trying to manage a very difficult situation. Obviously, they can't just let China Evergrande fail because the impact socially would be so negative that they just couldn't stomach it. But at the same time, someone has to lose money, or else they're just creating moral hazard, and they're doing the exact opposite of what they've been saying recently, which is, hey, we're going to clamp down on leverage. So they have to manage those things. It's going to be a very interesting situation. We've broken down in the chart here, of the liabilities of China Evergrande, who they owe money to, and you can go through these things and think, okay, well, who is China going to bail out and who aren't they going to bail out? A lot of people are going to get bailed out, and the people who are going to just lose money, they've probably already lost all the money they're going to lose.
Right. Yeah. I think that to your point, China wants to get rid of this leverage. They've got so much leverage in their economy, and they just want to sort of let the air out of the balloon slowly and make this go away. But it is not a global financial contagion.
Yeah.
That's going to bring down markets.
It's also so interesting that during COVID, when the entire global economy shut down in the course of a quarter,
right,
the silver lining, the positive part of the entire situation was, hey, at least the global financial system is in great shape, and banks can take this. Right. So
yeah,
the global financial system can take the COVID-19 recession, but the default of China Evergrande would be a problem. It doesn't make sense. There's not symmetry there. So it's just, you have to make a headline.
I think that's a good place for us to end it this month. Mike, thanks for the update, and to our research staff, thanks for all these great charts. And if you have any questions, let us know. We'll look forward to reviewing the October month in a few weeks.